Welcome to the Scottish Property Podcast. This is a show where we aim to educate, inspire and entertain through real life stories and interviews from people in the Scottish property community.
As always, thanks for listening and give us a follow on social media and subscribe to our YouTube channel. Remember to join us at our monthly networking events on the first Wednesday of every month. Tickets are available on our website. So without further ado, we'll just cut straight into this week's podcast. Okay, welcome to another episode of the Scottish Property Podcast. I'd like to be joined by Lindsey Devine, NM Legal. How are you today?
I'm good, thank you. Thank you for inviting me on.
It's good to finally meet you. We've heard so much about you in the group and the community, and lots of investors recommend dealing with you for the conveyancing. So
good. Yeah, a lot of my clients have been on the podcast or kind of listened to the podcast. So yeah, it's good to finally meet you guys as well.
And you're a good contributor to the group as well. So that's what it's all about in the Facebook group. You know, people are always looking to you for advice and stuff like that. So thanks for being so helpful.
Are you a modern day conveyancing solicitor then that you actually go on WhatsApp and, and Facebook communities and chat to investors?
Modern day and
you still
everything.
got a fax machine?
No, but we still have the facility to receive and send a fax, even though it's over email, because lenders require fax communication.
So it's not the solicitors in there, okay, just the lenders?
Well, there is some solicitors, but with me it's definitely not, but some lenders say that that's the only secure line of communication.
Yeah. That is crazy.
I know, it's crazy.
So what we're going to discuss today, on today's episode, listeners, we have brought Lindsey in as our legal expert here because something came about in the group where somebody posted about private money lending, and it was quite there's been a few cases of this actually, because we get reached out to all the time, and amongst our community, you know, it's a small property community in Scotland, and we have heard of a number of cases now where people have been lending out money and unfortunately not getting it back. So we want to do a podcast episode with yourself, Lindsey, to try and make people create an awareness basically about the pitfalls potentially, the risks involved, and how you can mitigate, you know, against obviously losing that money. Now, we're not going down the route here of naming and shaming people. That's not our game. You know, interestingly enough, it is the kind of same names that have popped up a few times now on these cases. But obviously, you know, that's not for us to deal with on the podcast. If you want to reach out privately, then we'll maybe share them. But we would never actually name somebody without giving them the right to reply on the podcast as well. So that's another thing. Anyway, but, you know, just starting off, I think we should really just look at potentially why private money lending comes about. Stephen, you're quite well experienced in taking money off people. So you can talk from a personal point of view.
Yeah, I mean, I suppose if anybody's looking to scale up their buy-to-let portfolio, no matter who you are, you're going to run out of money. So you've got to borrow someone else's money at some point.
Or you might not have any money to start with.
You have no money to start with, exactly. So raising private finance is a very, very key way of growing a portfolio. And Lindsey and I were just speaking before we started recording about the amount of portfolio transactions that I went through. So I think that does link well into why people are raising money is for scale.
Yeah. And some people, they'll see it as a quicker and easier way of getting money than going to a lender or a bridger or whatever. They'll maybe see it as cheaper, quicker, easier.
It's certainly easier, I think, as well. Because I mean, even if you're going for a bridging loan for your initial purchase and then an exit on long-term finance, for a private investor, they're not going to make you jump through the same hoops that a lender's going to make you jump through. So it is sometimes a lot quicker just to go sign the dotted line. Here's what I'm borrowing. Here's a term, and go. Whereas the bank's going to do a lot more due diligence on that. I suppose that's what we're here to talk about as well.
Yeah. Well, that's the point. And what you were saying beforehand is quite often if you're borrowing money from a private investor, you've not sometimes given them security or whatever. But obviously, from my point of view as a solicitor, I would always say if you're lending somebody money, take independent legal advice. You cannot use the same solicitor that the purchaser's using because of clear conflict of interest. That's a big no-no. So take independent legal advice and speak to your solicitor about how to protect your investment. If you're serious about making money and keeping your money safe and protecting your investment, then there are ways to
we'll
do
come
that.
On all that stuff. I'm just looking at potentially how all this comes about first of all.
So I think a lot of it would be if someone was looking to start and scale their portfolio, they can either borrow private investor finance to either buy the property outright, in which case the security is really, really easy to give and remove. But if they're looking into then using their private investors money as a deposit and use bridging finance for the rest, the bridging lender's going to take security over that first. So that's where I think the securities get a little bit trickier. But this is where, depends who your private investor is, how much they're lending and what you're buying on what you can offer. But effectively, you kind of need it to scale up because everyone's got either a limited pot or an infinite, and they've not got an infinite pot of cash. They can just keep buying. So this is where it's becoming more and more popular in the community as well. With anyone that's scaling, you'll see that they're borrowing money.
You will hear a lot about people, you know, they've got their investors, like, oh, I've got my investor now to purchase this deal or fund this deal and all the rest of it. Now, you know, a lot of people be thinking about these investors, thinking that these are guys sitting about and, you know, suits down some office down in London and all the rest of it, but a lot of time it can just be like, you know, somebody's granny or a rich uncle or auntie or something like that. You know, a lot of it is family members first and foremost.
A lot of it's family members that have maybe got a bit of cash and just don't want to invest in property themselves. They don't have the contacts or the time or the inclination to invest themselves, so they want to make some money from.
I think this is what's interesting with this podcast as well, which will shine quite a light on it, is it's not necessarily what you were saying, it's people with a lot of money, because people with a lot of money tend to be a bit more savvy. They're switched on, they've made the money in their business or their working career, they want to protect it. So the people that I see a lot of people borrow money from are the ones that, you know, have got 20 or 30, 40 grand sitting there. It's not a big pot, it's maybe their life savings, which isn't a huge amount of money, and they're not that savvy with it. I think that's where we'll end up having seen people fall down now.
What I was saying as well is, I think a common scenario that I'm seeing as well is that people are meeting on property courses or networking groups and stuff like that. You know, they're maybe going through a weekend course or a 12 months mentorship or whatever, and you get that person who's maybe a business owner who's got a bit of cash behind them, or they've just got a bit of money to invest, but then they do the course and they don't, you'll see this, Stephen, firsthand, they maybe don't have the time or they don't have the drive in them just to go and pull the trigger, but then they'll meet up with somebody and become friendly with somebody else who maybe doesn't have any money, but they've got the time, they're just going to go full steam ahead.
Yeah, I see that
a common kind of partnership?
Very, very common actually. I see that quite a lot, especially when mine are like very limited, like 4 or 5 people in a workshop for 4 or 5 days, and you're sitting with someone, and like you say, there are people that have different walks of life that will come in and go, I want to get educated before I start investing my money. Then they realise how hard work it is, how much due diligence, how much effort has to go into finding the properties and scaling up. Then they meet someone that's like maybe on the opposite end of it, that's going, shit, I'm starting with nothing, but you know, I'm hungry and I'm already been out there and I'm already networking, I'm already sourcing deals. So yeah, there's a clear, you can see it very, very early on that there's a partnership there and that person's going to lend them the money over.
And we've talked about the benefit to the borrower then, obviously, about scaling up, you know, if you're struggling to get, you know, bank funding, bridging loans, whatever. But what would be the benefits then to the actual lender? You know, obviously, you're talking higher interest rates than you would do having your money sitting in the bank.
Well, that's it, yeah. Most people with a bit of cash don't really know what to do with it, and they don't have the knowledge to get involved in property or get a return on it, or they don't want the hassle, don't want to register for it as a landlord or deal with tenants or compliance. They just go, I don't want to involve in that, don't understand stocks and shares, don't understand crypto, but they've got a bit of cash sitting there, and it might be someone, a friend, family, someone they know quite well. They say, well, they've got appear to have a track record, let's lend it with them, and yeah. So
they maybe get, say, 10% as opposed to...
1 or 2, 3 maybe now.
What's the highest you've ever given away, percentage-wise?
Yeah, it's usually about 6 or 7, but we've went up to 10 with some flips where it's made sense.
Right. Just depending how quickly you need it, how desperate you are.
Offered you 10% for 6 weeks return and you turn it down.
I'll never live that one down. And you've never asked again, so that's me burnt my bridges there, isn't it? So like, all that money
it's easy money, mate.
That money I could have made. And then obviously there is the whole point, you know, you hope that you're kind of in and out quick sometimes as well, isn't it? Like depending on the loan term and stuff like that.
Yeah, well that's the thing is most of the private investing finance is in and out. But the private investors we work for long term, so we're giving them the benefit of the owning a portfolio without owning a portfolio. So you invest 100 grand, 200 grand with us on a 3-5 year term, you get paid monthly with it.
And you tend to find these lenders are interested in property, or is it a case like they're really just wanting a decent return? Or, you know, do you find that, because I sometimes feel like there's other people that are looking to work with people that will lend them money because maybe they want to go along the journey and kind of learn along the way.
I've had that a couple of times where people will say, I'll lend you that money, but I am wanting to get involved myself, so I'm really looking to learn. And when they lend the money over, then they end up not taking advantage of the opportunity.
Right.
So then they realise that, this is a lot of shitload of work actually. They're going to be flat out, I can't make sight. And you realise that, you are a typical private investor, not a property investor.
Okay. So I think that sets the scene. So, sorry, Lindsay, I know you've been sitting there patiently while we discuss that. So bring you in now for the expert stuff. Due diligence, obviously. So, we've got these two people, the lender and the borrower. They've sort of either got an existing relationship going, family member, friend, or they've just met in a property course. The borrower's obviously found a deal and looking to fund it. Where can obviously that lender start doing due diligence before they hand over the money?
Well, obviously they want to instruct their solicitor, and the solicitor will do the kind of legal due diligence, which will be exactly the same as what would happen if they were buying the property. So their solicitor should be checking the home report, checking whether there's paperwork in place for the alterations. They should be checking the title, checking the searches, because they want to look at it as ultimately they could end up with this property and have to sell it.
So just pause you right there. So you've got the borrower who's agreeing the deal with the estate agent. So they're going to use a solicitor for the purchase. But you're saying that the lender, if that other person's involved, have a totally separate independent solicitor?
Correct. The same way that if you were borrowing money from a bridger, like Together or Lend Invest or something, the same way that they would have their own solicitor. So you'd be in a situation where there's three solicitors in the transaction: seller solicitor, buyer solicitor, lender solicitor.
Because you hear quite a lot of people talking about, you can just use my solicitor.
No.
Or we've got you hear a bit of that.
Yeah, so and I hear it too. I hear of people lending money to people, and the purchaser has said to them, I've got a solicitor, they'll sort it all out for you. That cannot happen.
I think, am I right in saying the only thing that can happen is that anti-money laundering checks that this purchaser solicitor will do on the private finance that came in?
Well, that's only if the private investor doesn't have their own solicitor. So if the private investor's got their own solicitor, the money will go to them, and their solicitor will do their AML checks. Then, because the money goes to the buyer's solicitor from the other solicitor, it's kind of AML.
That makes sense. Yeah. Actually,
approved
it's
already.
been done already.
Yeah. But obviously, this is the ideal scenario from us as solicitors saying this. But the reality is, a lot of investors don't instruct their own solicitor, whether it's to save cost or save time.
Do
or
you
just
encourage it if you see, I suppose that the private investor is not your client?
Exactly.
You're acting for the purchaser.
Exactly. So if we're acting for the purchaser and they say, I'm getting investment from a private investor, I'll say to them, have they got their own solicitor? It's for them to tell me yes they do or no they don't. But they're not my client, the investor, so I can't encourage them.
So I take it your only port of call then is just you just do your AML checks when that money comes in.
Exactly.
And is that quite common then?
Yeah, more common than it should be, really,
right.
I would say. Yeah. I'm surprised at how common it is.
Let's take a quick break, guys, from today's show to talk about selling your property with Prime Property Auctions. Now, myself and Stephen have both used John and Lewis from Prime in the past, and we can personally vouch for their service. They sell vacant and tenanted property, and you get to control the minimum reserve price so that you're not selling your property for peanuts. They pay for all the stuff like photos, videos, and all the marketing stuff up front, so you're not paying anything from the start, and it's a no sale, no fee. So if you want to check out Prime Property Auctions, then get across to the link on the show notes and speak to the guys. But I'm talking about even before you get a solicitor involved, right? Mm-hmm. What other checks could you do on somebody? Yourself, due diligence wise? I'm thinking a credit check. Is that something a solicitor would do?
No.
Right,
No.
so that's something I could do.
Yeah.
If I'm looking to lend you money, Stephen, that's something that probably not a lot of people do, but it's something I could do because it would potentially flag up issues like if they're back poor with money, they've not repaid loans, they've got CCJs against their name. It's something really easy. It's something that we do on our tenants all the time.
I was just going to say that the same checks you would do on a tenant. Yeah.
And it can...
So there's something I do I teach on the workshop, and I'm sure I stole a lot of like Rob Moore or something like that. It was like the CREST model. Have you ever heard of that?
No.
So when you're looking for a private investor, it's look for a CREST model. C is for the credibility. So they're going to look at you originally and say, is this guy credible or girl credible to lend the money to? And then it's going to be return. What return am I getting is one of the things they're going to ask. Next one's the exit. What's the exit for my money? When do I get it back? Then, how do I spell again? Security.
We're going to go through all them. Yeah.
And then, are you trustworthy? Can they trust you?
Right. And so, how do the trust? Let's still explore the trust, because we're going to get onto exit, security, and all the rest of it. We'll come to that. Trust. How do I gain trust in you then to lend you the money?
Well, this is where you when you start off, you kind of go to the people that Lindsay was saying, the nearest and dearest to you, friends, family, the people that have known you for years, that know your personality, know that you're not a fly by the night. Oh, I've been online and done a £99 course, now I'm going to go invest in property. Can I borrow some money from you? They want to see credibility. They want to see that you're taking things seriously and you're doing due diligence, and stuff you've done in the past before shapes your future and what you've done already. So I think a lot of that's easy to raise finance with people you know.
Exactly, and the cases that we've had brought to us are generally, it's not good friends and family. Yeah. These are kind of sort of, they've maybe built up a relationship through a few coffee meetings where they've met online or something like that, through Facebook groups or through property networking events and stuff like that. Social media. Yeah. How can you sort of look at somebody's social media presence, engage them? This is where I think
we're here for the conversation. Is anybody can be this property expert on social media. We can all show the highlights, but we're not showing the reality. And I feel like that's where people's due diligence are slipping. They're taking things at face value, what's on social media and how it looks, without even doing a simple, let's go on company's house and see if they're actually legitimate, or carry out a CCJ or check anything. Like, they're not doing any due diligence. They're looking at, let me look at his Facebook. Oh, he looks legit. He's posted a few before and afters. Do you know what I mean? I can get that from my mum flipping back.
I think there's different levels, right? I think if you've been consistently following somebody, you use social media as well, Lindsay, for your business. I think you'll see consistent names that have been about, in the property circle. If you've been following somebody for, 5+ years and they've been consistently doing and delivering what they say they do.
How do you know that they're not at that place where they're away to just fuck it? They're away to over leverage, be exposed, take on a project that's too big.
I wouldn't go solely on social media.
Yeah.
So this is where I see it from. It's easy to raise finance and people give money really, really easy, but there's a due diligence process on that person, even if you think you know them.
Feel free to jump in on the social media thing at any point. What I'm saying is, if you're seeing somebody go in, day out, they're delivering, completing projects, and they're talking about figures, posting screenshots, all the rest of it, bank statements, this is the, it's just a little bit extra. Yeah. I'm not saying it's the be all and end all, but I'm saying it does help to build up trust.
It helps build that credibility to start with. But then what due diligence would you do at the back end? Would you advise doing my protocol would be a company house search.
Company's house. What would you do? You look at company's house at all?
I mean,
Lindsay?
We would look as part of the due diligence that we would do if we were acting for the investor. So on the borrower, if they were a limited company, we would get what's called a charges search against the company, and that would see what they've got outstanding in terms of floating charges with other lenders, and also it shows whether there's any liquidation notices against the company, all these kind of things. But I'm guessing, I mean, you've got to think of it as you're the equivalent of a bank here. So whatever credit checks and due diligence that a bank does on a company before they lend them money, and that's out with obviously what I do in the conveyancing side of things, but they must do credit checks in the background and look at the kind of credit worthiness and look at their other investments to see how exposed they are.
So you can use Experian just for the simple credit check, right? So anybody can use that. That will send them a link to the person that you're doing the check on. They need to agree to it. That's fine. That'll expose bankruptcy, outstanding loans, etc. if they've kept up to date with their mortgage payments and all the rest of it. Can I look at kind of what sort of life they lead kind of personally as well? Like, like if they got have they got a solid kind of family, they live in a decent house, etc. By the way, none of these things are anything that you should point your finger at and go, oh yeah, they've got a nice house, I'll give them the money. These are all things that you need to start adding up to create the full picture.
Yeah. I mean, remember, if you were borrowing money from a lender, like trying to get a mortgage, you would have to show them bank statements. I know, like Jonathan was on just the podcast, and he was talking just on one of his socials just a couple of days ago about be careful if you've got constant like gambling going through, things like that.
Let's ask for the bank statements then.
That's a good.
Let's ask for 6 month's bank statements.
Yeah.
And then you can see, are they falling into like overdrafts regularly? Do you know what I mean? Is there consistent income there? Do they have like another source of income that's kind of backing things up? You know? Yeah. The other thing, obviously, the company's house is a very good one, because I'm always wary of people where I type in their name and they pop up with loads of kind of companies that have been dissolved or liquidated. And I think that's not a great track record, is it, really?
I think in because I thought that as well, but I think in property development it is quite common.
For developments, yes.
Yeah, because one will be set up for a JV, develop out, finish, complete, profits away, collapse company. So you can see a lot of like stuff on that activity.
What about strike-offs?
But strike-offs, that's a different story, isn't it? Because then someone's not kept up with their responsibilities as a director, that they've been stricken off.
Overdue accounts.
Yeah, another one.
Or just accounts where you can go in and basically see like the numbers. I mean, it's hard to read some of these accounts, I think, sometimes.
Yeah, and accounts can be fudged as well to a certain extent. You know what I mean? You can make them look. You're not going to make your accounts look amazing and go and pay loads of tax if you don't need to as well. So sometimes not a clearest picture.
If you go in company's house, you see, like, cause obviously some of your company's been trading for a long time. You know, my company's been trading since 2017, consistently filing accounts year on year for the past 6-7 years. That's quite a good track record as well.
Yeah.
You know, so you can look at that.
I think all that part of the due diligence builds up that picture, doesn't it? To see if they're credible.
I'm pretty sure that a lot of people, these are basics that a lot of people are just missing. Even the bank statements probably show up quite a lot, you know?
That's quite an interesting one with the bank statements, though, because it's quite a... I mean, I would have no issue proving it.
Quite personal.
Yes, it's quite personal.
How do you feel about that if somebody asks you for 6 months?
But I think that's such a really, really good due diligence check. I hadn't thought of that before, so thanks, Jonathan.
You just better make sure that you've not got any dodgy bank transactions going on. OnlyFans.
That's what you say that. I was trying to think what the name was again. Like, what was that? Shut a bit hide that.
Don't show bank statements to your wife, do you?
That's a cue though. That's clear. Like any gambling.
Aye.
It's probably a biggie, because if it's small gambling and you see gambling, there's a hint of
like
gambling.
Klarna payments as well. Lenders don't like those.
Starbucks addictions. McDonald's.
but you can build up a big picture, and that's what the banks are doing when they're asking for. They're looking at a picture to see what they can see how you live personally.
Yeah.
Right. Okay. So we've kind of done that as much due diligence. We've built up a bit of trust with somebody. We've met them, you know, for a few meetings. So we've kind of we're there, like we're kind of on board with the lending. Obviously, the next bit is the kind of the protection and the security and the whole process of setting that up. So we've got a couple of things, haven't we, Lindsay, that we could explore. Let's look at the.
I think if you're going through like the kind of crest bit, I think before you go into like the security would be the exit. Like,
is it exit not? What would the exit be?
Yeah.
You want to know the exit.
So as a private investor, you want to know the exit. And what I'd kind of be keen to explore if I was lending money out as well is, what's your plan A, B and plan C? Because we all know in property, it doesn't go the way we think it's going to go. So if you're saying, oh, you know, I'm borrowing this 100 grand, I'm going to flip this property, I'm going to make 60 grand profit.
Yeah.
What happens if you can't sell it? What happens if the renovation overruns? What happens? Do you know what I mean? So
let's talk about the exit. No, it's really, really important.
So I think when you speak to an investor, you want to say, well, my exit's going to be I'm selling it, or I'm using a bridging loan and I'm going to put in a long-term finance, or if I can't sell it, I'm going to put a mortgage in it and keep it. So I think to show that you've got multiple exits, that you're getting your money back by method A, B or C, I've got my...
So taking your example, the flip there, obviously the main exit, or the first goal is to obviously sell it at a profit. So what would the other exit be?
So if you couldn't sell it or the market conditions changed, then you'd be looking to put a mortgage in it as well. So I'd be wanting to make sure that the profit margins was more than 25%. So when you put a 75% loan to value mortgage in it, you're still at least getting the private investor money back out. That makes sense.
Yeah.
Right.
So would that be a buy to let mortgage then?
Buy to let mortgage, yeah.
So as the lender, as the investor, you need to really be kind of switched on with that as well, then kind of looking to see that would still work, and you know, those interest rates the way that they are.
I mean, I'm giving this advice like I'm a private investor, but if anybody asks me any questions on the property deal, I'll walk away from that private investor, because I don't want that, like, the credibility of the trust should be all built up in the background, that when they come in line with the money, they're like, yeah, I've trusted you, I see your company says I've done all my due diligence.
So if somebody starts asking these questions about exit and all that,
I'd bail. But then in the conversation that we'd be having in a coffee meet up or a chat, they'd be clear. Oh, what's this money for? Whatever it is. I mean, not that they ask them where the money's going, but where's it going? What kind of project's going? And if they ask you a couple of questions, you're having an informal chat. You'd soon get a feeling. Oh, the guy's flipping it. He knows if the market changes, he's going to buy to let, or he knows he's going to SA, or he knows he's going to. Do you know what I mean? There's 4 exits with this property.
Right.
So,
but you're saying that this level of due diligence is potentially going to put people off.
No.
If I start grilling you on what's your exit, what happens if this doesn't happen?
I'd have this conversation with you up front that you wouldn't need to ask it. But for a private investor, I'd be wanting to know that.
Yeah.
I'd be wanting to ask that. And if I didn't have that in that conversation, I'd be asking. Right, okay, you're selling it, but as an experienced property investor, I know that things don't go to plan. What happens if your refurb runs over by 60%, or you can't sell it, or you find a structural issue halfway through it, or do you know what I mean? I'd want to make sure they were competent enough in doing the development enough that there's the exit's always going to stand up.
But as the lender, right? Say you're buying a property for $100,000, right? Now, obviously, if you're funding 100% of the purchase plus renovation costs, say they're giving that borrower 125, say, you're going to want to know that how much would you be doing research on property values? Would you be doing comparables and want to know the comparable if you're the lender? Because you want to know that if that property doesn't sell,
I would.
You want to know that if it has to go on to a mortgage,
or you have to take possession of it and then auction it, you want to know you're at least getting your money back.
So your ways to get your money back are if that borrower needs to go on a mortgage at 75% loan to value, are you going to get your money back out?
Yeah.
Or if they have to sell it, then...
Yeah.
But if it's no selling, is what I'm saying.
Well, so that example there, you're giving like the $100,000, $125,000, but if that end value wasn't at 170, 180, your money's at risk.
Yeah, okay.
So because you put a 75% loan to value on that, you're up to your 120, 130.
So what's these solid sales comparables of what they're trying to achieve?
At least to have a bit of due diligence on the actual property. If you were that's saying you're investing in a specific deal. You might just be investing into somebody's property company that's grown their portfolio and it's not going to go into one particular deal. So yeah, I would want to be seeing exits.
Especially if it's like first time working with the person
absolutely,
as well. Aye. So no, exits really good, really good. There's somebody used to come on the Facebook groups all the time, exit. It was always the fun. What sort of things should be checking for? Exit.
Absolutely. And I suppose it's where it comes on to Lindsay's expertise. The next one will be the what security you getting.
Yeah.
Right, well, so the loan agreement then?
Yeah, I was going to say that. Before you get to what security you're taking, think about the loan agreement.
Right.
So the terms and conditions of the loan, we would expect the borrower and the lender to kind of negotiate between themselves. The same way that if you go to a bank, we as solicitors don't get involved in negotiating the interest rate or the term of the loan, the sort of date, that the due date for it being repaid, things like that. So if you come to us with some clients will come to us with a loan agreement prepared, probably something they've pulled off.
Let's a loan agreement. It's not like some people might be thinking, oh, this is like a hugely complex document that's pages and pages. It doesn't necessarily need to be that, right?
It doesn't need to be that. No, you should definitely document that it's a loan. That's an important thing.
I'm laughing at that solicitor saying it doesn't need to be.
Yeah, it doesn't need to be that.
What the basics here is the interest rate.
Yeah.
The loan term, which is the time.
When have you seen a solicitor write out in basic format that one page covers it? She's laughing. It's going to be it was about 10 pages long.
It's going to be a few, but it could be as basic as what you're saying.
Yeah.
It definitely needs to state that it's a loan, because the presumption in law, if you give someone money and don't document it as a loan, is that you've gifted them the money. Right. So you don't want that.
So basically what you're saying is don't do it on ChatGPT.
You've not got up on you.
Listen, everybody, I know this is the problem. Everybody wants to save money and avoid legal fees, but you. That is what we're up against.
Absolutely.
But as solicitors, like, we can't force somebody to take legal advice, and we can't force somebody to pay us to do them a 10-page loan document when they've got something for 2 pages that they think is fine.
How much would that cost to get a loan agreement?
So, I mean, the whole process of getting the loan agreement drafted up plus the security would be anywhere between maybe £500 and £1,000 plus that.
So it's not huge.
It's not a huge amount of money.
Spent, I would say.
It's not a huge amount of money to protect a massive amount that you're investing.
Yeah.
So that's why I'm surprised that so few people do it properly.
Yeah. No, that's quite interesting.
Yeah.
I put one thing on my loan agreement when I got one done, knocked up by a solicitor as well, but I did one in it, and it was just that it didn't, the knock up one the basic one, the 1 or 2 page one, it didn't really go into a huge amount of detail. But one thing I made sure I added into it when I got the solicitor's one done was where the money would go to in case of deaths. Who's responsible for it if I die? Who's responsible if they die? It has to go with their estate and be shown that the loan, they've given me 100 grand. If you die, it goes to your estate. And I think even having that inside the loan agreement gave that bit of credibility to investors to go, well, you've thought about it. My money's not just disappearing and then something happens to me and no one knows about it because this one-page document's lost in...
The other thing I would mention as well is it's up for negotiation between the borrower and the lender who's paying the lender's legal fees, and it is quite often the case that the borrower, i.e. the purchaser, will pay their legal fees plus the lender's legal fees. But that's where it becomes a matter of negotiation between the parties and how much the lender wants.
As a private investor, you'd want to pay that 500 quid, £1,000 just to protect your own investment, surely.
You would think so, yeah.
Okay, so you've got the loan agreement. That needs to be signed by both parties.
Yeah, and the loan agreement is simply a contract between the two parties. So it is worth something, but it's not, that in itself doesn't give you the right to repossess the property. That's what the standard security does.
Right.
And is that otherwise known as a charge on the property?
Yes.
Standard security. We're just getting used to all this jargon here for people that are starting out.
So a standard security is a charge over a specific property. So that's what you give the bank if you're taking out a mortgage.
And the bank will always take a first charge, won't they, usually?
Can you explain the charge rankings to the listeners then? Just for people that
So if you are buying a property and getting a mortgage from a lender, they will always insist on what's called a first ranking security or a first charge. So that means that their money is got priority over any other money secured against the property. So that means the debt outstanding plus any interest accrued and any legal expenses that the lender has to incur in repossessing the property all ranks first. So that's why if you're ever taking a second charge, you've got to make sure to account for, is there going to be enough left? And which is why there has to be a decent amount of equity before anybody would consider a second charge. So if the property is repossessed, first lender gets their money back first, only if there's any money left. Second.
Does it go much deeper than second, or is it for bigger developments, does it go deeper than that?
You can have as many as like infinitely you could have, but in reality you would never.
The lower down, the higher the risk.
The reality is you would never see more than 3, and even then it's very rare.
What about the upper one that I always find that people go on the courses that don't do property, they don't mention is the bond of loan charge. Everyone comes off it and gives away bond of loan charge straight away, and they can't.
What is that you're saying?
So the bond of floating charge.
Bond of floating charge.
Bond and floating charge. So floating charges, this is, it's quite a complicated area. This is totally different to a standard security. So only a company can grant a floating charge, an individual can't. It doesn't attach to a particular property. So it's not secured against one particular property. It floats, hence the name, over the ever-changing assets of the company. So that covers any properties in your portfolio or any money in the company bank account, if there's a company car, all these kind of things. It floats, and obviously assets come in and out of the company's ownership over the term of the floating charge. But if you default on the loan, the bank or the lender, whoever's got the floating charge, can what's called crystallise the floating charge. And you imagine that means it's like a kind of net that falls down and catches everything in the company's ownership at that time. Floating charges are a total headache for solicitors when companies borrow money with different lenders.
We refuse them because
it causes so much hassle.
So you've got to watch what lenders you go to. But
exactly.
Why I was wanting to bring that up was it kind of almost belittles the first charge security. If a private investor lends a first charge security over a company that has floating charges in it, because the private investor might think, I've got security, they're borrowing inside this company, I've got first security over that property, but if the property already's got lending with Lendinvest and they've got a security, a floating charge over the company, then if the company lands in a problem, they could pull that asset off them, and even though they've got a first charge security, is that right? Yeah,
but a floating charge isn't as good as a security. So if you've got a floating charge and then you grant another lender a first ranking security over a specific property, you have to get the consent of the floating charge holder,
to release it.
They have to consent to you giving first rank in security to another lender over that property, because what that basically does is it gives the new lender better security than they've got. So it is quite quite complicated.
Getting off that complicated stuff, because that's well over my head. Going back to the basics, let's just stick to the first charges just now.
Okay,
the standard security.
Yeah.
Now, you obviously register that.
Yes.
Where do you register it?
Registers of Scotland, first of all. So
Right.
this is the lender's solicitor registers the security because it's in their interest. It registers of Scotland, first of all, and that goes on the title sheet. You'll see that in your section C of the title sheet. It also has to get registered at Companies House if it's a company borrower.
Which is quite common nowadays, because lots of people are using limited companies now to invest.
This is and explaining the whole charges is the easy part of doing due diligence on someone, because most people that are buying a portfolio have got some form of borrowing. So you can actually see what charges they've got and what charges they've got satisfied on Companies House. So it's actually very easy if they've done it right.
Yeah. And remember, if you're lending money to somebody not for a specific property purchase, maybe just for ongoing projects, you could take a charge over another property that they happen to have.
That's a really good tip.
Yeah.
That's a good point. It doesn't necessarily need to be that property.
No,
it can be any property.
It could
as
be
long
any
as it's
property.
an asset and there's equity in it.
And this is where it kind of comes back to the due diligence then, because you'd almost have to see a portfolio schedule, what the borrowing is, what the property value is, then go and do your due diligence, say, well, I want to pick that property to do it because that's not got enough equity in it. You'd have to do a lot of due diligence.
So some investor clients will choose to, if they've got an unencumbered property, they'll offer that to somebody as they take charge over that because it's not got any mortgage on it.
Yeah.
So say I've agreed to do the first charge, to get a first charge in the property, and I've got my $100,000 there to basically fund, I don't know, the purchase and a bit of renovation, whatever, and I've got you acting as my solicitor. The buyer / borrower, they've got another solicitor, they're doing their bit, they've got the agreed completion date. At what point, do I pass my money? Do I put my money across to you first, then you put it across? How does the whole process piece together in terms of my money and how it gets protected?
So long as the money is available for completion, obviously solicitors do like it a few days before just to do all their EML checks and things, but while the money's with your solicitor, it's obviously safe, but they're not going to then transfer the money to the buyer's solicitor until the security's been signed and it's in their possession. So that means you're ready to register it.
Right. That's how you fully protect yourself then.
Yeah.
Okay. Yeah. You don't just put the money into the buyer's bank account.
Definitely not. Though.
No.
You're sending it through your solicitor via their solicitor.
Yeah.
Got it, yeah. And then that makes sure that everything's there, the standard securities getting registered and all the rest of it. Aye, just on it to chat about second charge, because you hear that all the time. Oh, you're happy to give you a second charge, but you really need to be wary on that one, like you say, Lindsay.
Yeah, you need to make sure there is a decent amount of equity to cover what you're lending.
Okay, so we've agreed that we're going to lend the money. $100,000, 12 months, say? Let's just give a scenario.
Is that a common loan agreement term?
Yeah.
Right, it's just to give a working example so we can follow it through the process.
Yep.
Comes to the end of the 12 months, I want my money back. The project's not completed. They're dilly-dallying. What do we do if it's not going according to plan and I need my money back?
So this is where the borrower has to decide how they're going to give the money back. If they're struggling to sell the property or if they've not finished it, they could refinance it to obviously get money from a bank to then pay back their investor. They could try and agree an extension, which might involve obviously additional interest and things like that.
Renegotiating the original loan agreement, basically an extension. Maybe if you're the lender, you're seeing, well, things are progressing. Like they've maybe sent me a video update or you've visited the property. You're seeing some sort of progress.
I think that's key from the people that are borrowing the money as well, is that almost investor relations. Like keep your investor up to date. If the 12 months is coming up to it, touch base with them in month 6, month 9. Everything okay? You still want your money back at 12. If you know you're going to foresee that you can't sell it or exit at the 12 months, be up front months in advance. Say, by the way, not the week before. You're like, right, I'm ready to spend my $100,000
Right.
for my other project. And then they go, shit, I can't give it to you.
Talk about that. I touch on that a little bit further. Investor relations, keeping them updated. Are there certain people, because you've talked about lending a lot, you've lent a lot of money.
Oh, I don't hear from them, and you give them an update, and they're not fucking interested.
Right.
To be fair, but they're
so it depends.
They're the investors you want.
Right.
Like obviously the best investors. Like one of them, the only update I'll get from him is thanking us for funding his retirement in Portugal.
But is that because you've got a track record previously?
Yes, aye. So
you've already built that.
You built that track record from just say a loan agreement, like Lindsey was saying there, for a year's term. You come at the end of the year's term, say, what do you want to do at month 9? Do you want to extend it? And they're like, do you know what? Yes, give me another year, give me another 3 years, whatever.
But I think communication's got to be key at the start.
Has to
for
be.
that first one.
Yeah, even throughout it, even at the 6 month point, here's what's happening with the project. You invested your money in this. It's at this stage. It's almost ready for the market.
Right.
Your money's going to come back 3 months earlier. Do you want to extend it, or do you want to go again, or you want earlier? I think that the communication is key in that, because at the end of the day, it's someone's money. It's someone's money. They're going to be nervous about protecting as well.
I suppose it'll also depend on what you've agreed and how you're going to pay them back. Because if you're paying them back monthly interest and they're getting that every month, they're going to be happy.
Yeah.
A lot of people do that. They'll leave the loan agreement. They'll say, "I'll pay you at the end of the year." Now, and I did do that a lot to start with flip projects, because you're always worried about the cash flow, and you're thinking, well, I'm borrowing that $100,000. I'll pay 10 grand at the end of the year. I don't have to worry about it now. But I suppose as you grow the portfolio, I'll do like to pay them all monthly, because it's service from the portfolio as well. But then the investor almost feels, like you say, at ease. Like they're getting 800, 900 quid a month for that $100,000. They're happy that they're actually getting a return. So it's only the working capital you have to return back at the end of the project.
Where I have heard it go wrong in a couple of situations, and it's really interesting, it's not obviously interesting for the people that have lost the money, but looking at it from an outsider point of view, it's like some people get into they get tangled up, and it's almost like they get to the point where it's robbing Peter to pay Paul. Right, so the initial loan term is coming to an end, and that person's putting pressure on them, and then something's gone wrong with the project, or they've not got that end value on the refinance or something like that, and they're out of pocket and they can't, or they've used the money even to go to first class trips to Dubai or something like that, just pissed up against the wall, just anything, I don't know, and then they're under pressure, so then they go and raise more money off the next investor, and then pay. It's like a pyramid scheme, and eventually it gets further down the line, and you start getting more and more outstanding debts, and then it just all collapses eventually.
I suppose this is where they'd be doing the due diligence, and not what we're talking about up front is like, just look at someone's track history on Facebook for a couple of years, and if they're doing deals, and that could be that situation you're talking about. They could just be robbing Peter to pay Paul and digging a bigger and bigger hole. So you'd have to do that bit of due diligence and look at what's other assets have they got in the background, what's the portfolio looking like, what's the leverage looking like.
You must have had people come to you about situations where they're looking for advice. I'm not saying name names, I'm not, can you give us any, just in general terms, where potentially it's gone wrong for people?
I mean, most people that get into that situation will look to try and refinance, I would say, or I suppose sell the property maybe at a loss and try and negotiate. I guess you would have to try and negotiate with the investor. You're maybe not going to get all of it back, but you get some of it back, and maybe try and do some sort of deal with them. But it doesn't, I would say it doesn't happen that often.
Right. Worst case scenario though, if you have the first charge on the property, you can repossess, right?
Yes. Yeah.
There's legal proceedings. It's not something you do.
Yes.
You pass that on to
that would get passed on to a court solicitor. But if you've got a first charge over a property, just like a mortgage lender, you've got the right to repossess the property. It does involve having to go to court, but it is a formality in the sense that you've got the charge.
Extra costs there involved and all the rest of it.
But your legal expenses would also get recouped from the borrower.
And I think it can take quite a few months as well.
It can do, just because of court processes and things.
But then obviously that is why you go down that route, and potentially, as long as the market hasn't really dropped in its arse, then you would hope that you would get
And the markets
your money
tend
back.
to not drop that fast that someone's going to get caught with their pants down if something's went wrong, innit? And this is what I'm always looking about, the profit margin in it. If
Well,
the
they
profit
did in
margin's-
2008, the banks.
But even when they dropped in 2008, what did we see? We looked at it before, and it was like, I think the biggest drop was like 20%. So when you look at it, your profit margin might be gone. The borrower might not make their profit, but as long as their due diligence is done right, and they can still give the investor their money back, it's when they've not got the track record, the experience to actually. The numbers aren't right in the first place, that they've made an asset, and they're like, "Oh, I've not."
That's why a lot of lenders will also take personal guarantees, though, because if the market does crash and they can't recover their debt from selling the property, they've got the personal guarantee.
Let's talk personal guarantees.
I was going to
then.
ask that as well. Is there an insurance policy for personal guarantees?
Wait a minute, I'll just explain
What do you mean, an insurance policy?
Because I saw it was just something funny. I put a reel on Instagram about a year ago, and Lend Invest. I don't know if I can name them yet. Lend Invest emailed back to us when we were putting through our mortgage application, basically saying, how the hell have you built this portfolio in this particular company, like £9 million over a 2-year period, and all we ever take out the company's 40 grand a year. So they questioned, obviously, where the £2.5 million the equities came from. Obviously, it was private investor finance. But my wife asked me that very night when she saw that reel, is our house at risk? And I was thinking, our house was at risk a fucking long time ago. Like, that's gone. So then it made me think, well, I'm signing a personal guarantee on every buy-to-let mortgage that I've got in that company, and there's over 100 properties in there. Like, where does the personal guarantee stop? Because
What's it really worth?
what's it worth? Because if some point I don't know what's my house worth, 400 grand, 450.
And you've got
that's gone.
£2.5 million outstanding.
No, there's £9 million debt, £8 million debt. So
All right.
where's the personal guarantee go? Who gets rank of it? And that's what was making me think. Everyone's changed to company-let mortgages the last 6, 7 years, 8 years. It's become so big. Everyone's forced to sign a personal guarantee.
Yeah.
What is the
happens
point?
when it
What's the
pops?
point when you get to that level
Yeah.
that Stephen's playing at that level? You think, what's the point? Is that what you're...
Yeah, like surely, we sign them like they're flipping buying that stickers.
I know.
Like, they
This
don't
is
care.
something we talk about in the office quite a lot. It's kind of worrying how easily people sign personal guarantees. So personal guarantees, so yeah, what you were saying there, Nick, is correct. Like, if you're getting any borrowing now in the name of a limited company, you will be asked to sign personal guarantees. So any benefit of limited liability is completely wiped out.
Basically, if you've got your house, if you own your house, any
Yeah.
personal assets...
Your house is at risk. Yeah. And you have to take independent legal advice for personal guarantees.
Which
And
we'll waiver.
Some lenders will let you waive. But honestly, like, people come to us all the time and say, oh, I've got this document that I need witnessed by a solicitor. That instantly makes me think, you have no clue
What
you're signing and what the implications of that are. So it's not something your solicitor has to just witness.
Yeah.
It's something we have to give you independent legal advice on. So you need to really understand the consequences of a
But you
personal
have
guarantee.
no choice.
You have no choice. Well, I say to clients, you can choose not to sign it, but you'll not get
the mortgage.
You'll not get the money.
So what I'm saying is, anybody wants to own a buy-let portfolio has to sign personal guarantees, and we're all numb to it the last 5-6 years that we're signing we're just giving
they
away.
sign it and they just see it as an inconvenience, see it as
It's
extra cost that you
complete
think
inconvenience.
solicitors are trying to make money out of you. This, that. It's.
But don't take Stephen's advice.
No, don't take my advice.
You should definitely tell your wife or your partner.
But I mean, most people's personal assets
It's
are
the
going
house.
to,
Yeah.
you're going to outstrip the value of your house in a portfolio worth a couple of million that most people in our community are building quite quickly. So
I think the logic is probably that lenders will get majority, if not all, of their money back from the standard security, and it's only in a worst case scenario where they don't get the money back
There's a
from
little bit.
that they can maybe get extra from the personal guarantee.
Because the thing is, like, what other assets, personal assets, do you have? Maybe like, I don't know, pension or something. Is that something that can be? Would that come under personal guarantee? Yeah.
Any money, anything in your anything in your
like,
personal.
we don't own our cars, do we? So like,
company assets now. I suppose.
don't know what else you're going to give away your kids. Take my children. I don't know if anyone would want them. To be fair.
I always actually wondered that if there's got to be an insurance policy coming out that people could start paying for insurance, just to say, if my personal guarantee is called upon, but because, like you say, like historically, if you do any business activity in a limited company, you've limited the liability into the limited company, but our property investment strategies are just not getting away with it, and
No.
rightly or
Likewise,
wrongly.
if you've got a limited company bank account and you try and get an overdraft from the bank, they're going to make you sign personal guarantees for that as well.
From the private lending point of view, would you? I mean, I don't hear many people talking about getting personal guarantees on the private lending. Do you?
Some do.
Yeah, some do. So it could be a potential extra thing that you could throw in there.
Yep.
Okay, that's good to know, and not a huge extra cost for that to bolt that on.
No.
Right, that's fine. And is there anything? But like, how would you then? Like, would you just take that person's? Would you ask them for a statement of assets or something like that, so you could assess what they've got?
I suppose that would be part of your due diligence that you've done in advance, looking at their credit.
Give me your
files and
mortgage
things like
statement
that.
or something like that.
Yeah.
What have you got? Aye, I mean,
Yeah.
now that we're going through all this, if we give people a 20 to 30 point checklist, like the chance of them
lending money.
the chances of lending money now are pretty. I don't think they'll ever do a deal now with all this due diligence checklist. But at least we've put it out there.
We've put it out there. It's actually interesting that the conversation went that way, and you can actually see how much due diligence is actually involved in doing it.
If you wish to do, you could certainly protect yourself. And I think if you did, the point is, if you did all that we've talked about today, you're mitigating hugely the risks.
Yeah.
I mean, we all do that in the properties that we're buying, developing, selling, keeping, holding, everything. Every strategy we do in property, we do so much due diligence. I kind of don't understand why people don't do as much due diligence when it comes to lending private finance.
Yeah, and mortgage lenders do that, so and they know what they're doing. So you've got to think of yourself, put yourself in those shoes, and do it. Yeah.
I mean, it's interesting what you're talking about. Mortgage lenders as well. I mean, again, look at loan to value. You know, they're only lending 75%, 80%, saying, well, you can get the occasional 85. You know, I know it's different with bridging and all the rest of it, which comes at higher cost.
But even when you look at like a mortgage lender or a bridging lender, they're still going to want to look at a little bit of due diligence in the property, what you're buying, what the end value is going to be, what your renovation costs are going to be, and look at a little bit of track record before they even lend you money. So if you're following the same protocol as a lender would do, you're safeguarding your money, aren't you?
I think you've also got to go with gut. I mean, I talk about this as well with my team when we're doing all our checks on a tenant, but you do need to take an element of gut feeling into it as well. And you know, you've probably not got off to a great start if you're having to chase somebody right at the start for answers and they're not transparent.
Yeah.
Say they're not completely transparent, or they're withholding information.
Yeah.
Or you might ask for that bank statement and they might be not giving you my bank statement. Then you can probably just walk away at that point.
Yeah.
Some people lurk in the shadows and try and raise private finance, and I think that's quite sneakily as well. Because if you're being transparent out there, we said that off air, like, where am I going to go with private investor finance if I don't pay anybody back? I'm not turning up once like to record these podcasts every fucking week. You're soon going to know if I've done anything. But you're out there, you're putting yourself out there, and like that's hope shows people a bit of credibility that, well, he's not going anywhere. They're on social media, they're posting their deals, they're posting what they're doing in their business. Like there's a lot there.
Another thing is, you know, another wee tick list is just get in touch with yourselves and we'll give you a wee blacklist of names.
We should create one actually.
And we'll put that as we could sell that as a wee extra.
Yeah. Podcast extra.
Blacklist.
Tenant blacklist. Private investor blacklist.
No.
Tradesman blacklist.
Lindsay, it's been good. Is there anything you want to add to that you think that we might have missed out on?
I don't think so. I think really just trying to hammer home the importance of taking legal advice, and that's not me trying to like boost like business for myself. I'm busy, so go speak to your own solicitor. Make sure it's somebody that's experienced in this type of thing. It might not be your family solicitor that you've used for buying your house and making your will. They might do it, but they might not be experienced in these kind of investment transactions.
Do you ever try to talk somebody out a deal if you like?
No, that's not my place to do that. No, because I would never give a client financial advice. So if a client says to me, "What do you think is a good deal?" I'll say that's not my job.
So
that's interesting what you said about the solicitor and speaking to the right solicitor, because I find that people make that mistake when they start in property. It's like, oh, my mum or auntie or uncles advised me to go to so and so, and they're not a conveyancing solicitor doing buy-to-let mortgage into the limited company, or they're not dealing with private investor finance. So we know that you get recommended all the time in the group, so you know that you're doing. I
talk about this quite a lot. Is like, if you're going to be getting finance from people like Together and Land Invest and these types of bridgers that have their own solicitor, your solicitor has to be used to dealing. So you're in this kind of three-way situation where you've got lender solicitor, we're the buyer solicitor, and you've got the seller solicitor, and you have to be able to manage and juggle plates at the same time.
I do remember the first sales going through with Together Finance, purchase going through with Together Finance, and they use Melix, I think, as their solicitor in Glasgow.
Yeah.
And the way they do things are so much different.
Yeah.
The first solicitors I was using were like, it was taking months to get something over the line.
Yeah.
And now you work with a solicitor that knows.
Yeah,
how
they know the
work.
process. And when you get used to the ways that Melix work, or like Brody's who act for Lend Invest, and you know what they're going to ask for, so you can kind of preempt it and get everything lined up in advance, because this is a problem. Like, investors, bridging is sold to them as like quick and easy,
and it won't be if
and
it's,
and bridging your bridging loan can be approved really quickly, but then the legal process can be longer because there's a third solicitor involved, so you need to be able to keep everything.
Just to touch on that point, like, you know, I don't give financial advice, and that's not my job, and that's not my place. This is the whole point in doing this, though, because there's not going to be one person that you can really go to that's going to say, oh yeah, you should do that deal, or you shouldn't. So this is why this is so important, because you need to ultimately make that choice yourself and assess that risk and be comfortable putting that money in if you're the lender.
And all your solicitor's there to do is to protect you as much as possible, but it's your decision whether to go ahead with the deal. And
like any kind of investment, your money's always going to be at risk.
It's always a risk, isn't it? Yeah.
Cool. I think it's a good point to end on. Give your company a shout out. Where can people reach out to you?
So NM Legal, we are on Instagram. I think it's nm.legal, on Facebook, NM Legal, and my own email address is Lindsey, Lindsey, at nmlegal.co.uk.
Thank you so much. Keep up the good work, Lindsey. Thank you very much.
Thank you.